Okay, forget the daily headlines for a minute. The real story happening in the market right now is this massive tectonic shift happening right under the surface. We're talking about a huge rotation of money. And believe me, it is happening fast. So we're going to break down what's getting dumped, what's getting bought, and what it all means for you.
And listen, that's not an exaggeration. This isn't just some minor dip we're talking about. It's a full-on fundamental pivot. The big players on Wall Street are making a really decisive move, and it has a name, a market rotation.
So what in the world is a market rotation anyway? Well, the easiest way to think about it is like a changing of the guard. All the money starts flowing out of those hot sectors that have been winning for years and into new areas that, might have been kind of overlooked. It's a totally normal part of the market cycle, but wow, if you're not paying attention, it can really catch you off guard.
To really get this, we first need to look at where the money is coming from. I mean, for years, tech has been the undisputed king of the hill, but the tide is definitely turning. So what's actually getting sold off? Let's dive in. Ground zero, the absolute epicenter of this sell-off, AI software. Yeah, the very same sector that was riding this incredible wave of hype is now facing a pretty harsh reality check. We're seeing huge names like Salesforce and Adobe hitting yearly lows. Seriously, the word on the street for this sector is radioactive. And here's the crazy part, the ultimate irony, right? The AI revolution is starting to eat its own. These new AI platforms are so powerful that they can replace multiple older software programs for just a fraction of the cost. This is putting unbelievable pressure on prices and making it super tough for the old guard to compete. And if you want to see just how serious Wall Street is about this, look at this number. We are talking about $24 billion. That's how much hedge funds, some of the smartest money out there, have made by betting against software stocks just this year. They're not just selling, they are actively shorting this sector because they expect it to go down even more. Okay, next step on the chopping block. Let's talk about the companies that are building the physical backbone of AI. All those data centers, chips, and servers. The problem here is pretty simple. Investors are just running out of patience. These companies have been spending an absolute fortune on AI infrastructure, but the profits, they just aren't showing up yet. A recent MIT study even found that most of this spending has had no measurable return so far. The market is sending a loud and clear message: show us the money. And finally, let's talk about the biggest names in the market. Now, they're not getting hammered quite like the software stocks are, but there's this quiet exit happening for a very simple, almost mechanical reason. This donut chart tells the whole story. See that huge slice? That shows that just 7 companies make up a third of the entire S&P 500. For these giant investment funds, that's a huge red flag. To manage their risk, they literally have to sell some of their biggest winners just to stay balanced. It's not that they've lost faith, it's just smart portfolio 101. Okay, so if all this cash is pouring out of tech, it has to go somewhere, right? So where is it going? Let's follow the money and see what's on the other side of this big trade.
And you can see the rotation happening right here in living color. The bar on the left, that represents the smaller companies, is just dramatically outperforming the big guys on the right so far this year. And this isn't just some random blip on the radar. It's a clear trend showing exactly where the money is flowing. So why the sudden love for smaller companies? Well, for one, they're cheaper. A lot cheaper. They also stand to gain the most when interest rates, eventually fall, and their earnings are actually forecast to grow faster than their bigger cousins. It's really no wonder that major banks are so bullish on them right now. But it's not just about company size. There's a bigger theme here. We're seeing this fascinating shift away from the digital hype of AI to the real-world, tangible things needed to make it all work. Think of it as the physical AI trade. And this table really backs that up. The performance numbers show money moving into the actual building blocks of the economy. Basic materials for robotics, they're up. Energy to power all those data centers, surging. Even financials are doing well. And with all the economic uncertainty, it's no surprise that investors are also turning to real, hard assets like gold. So we've covered the what and the why. But now for the most important part. What do you do about it? Let's walk through a simple playbook for how to navigate this kind of shift. Now, the goal here isn't to time the market perfectly, because let's be real, nobody can. It's all about being prepared for the opportunities that a rotation like this can create. Here's a simple 3-step framework. First, reevaluate. Take a hard, honest look at your portfolio. Are you maybe a little too concentrated in tech?
Second, keep some dry powder. That's just cash on the sidelines, so you can take advantage of any dips. And third, be selective. Use this as a chance to buy high-quality companies at a discount, not just, anything that's on sale.
And this quote from Robert Schein really just hits the nail on the head. The main takeaway here is that this is about rebalancing, not abandoning tech altogether. I mean, great tech companies are still great long-term investments, but the market is telling us it's time to look at other opportunities too. So, I'll leave you with this. As the digital darlings of the last decade start to cool off, a whole new landscape of opportunity is emerging in the physical world. The real question is, will you be looking in the right places to find it? Because the next market leaders might not be where you expect them to be.